Welcome to The Explainer. I am absolutely thrilled to have you here today because we're tackling one of the most vital life skills anyone can possess, mastering investment products. To make this diploma-level masterclass truly practical, I want you to picture a specific real-world scenario with us. Imagine a Toronto-based tech consultant. She has just grinded through her first 3 years in business, working late nights, and she's finally secured a major profit surplus. It's sitting right there in her bank account, and she needs to protect it and ideally grow it. But how? Well, that is exactly the journey of a dollar we're going to trace today. But hold on a second. Before she can even think about growing that money, our Toronto consultant has to face a silent, almost invisible enemy. We really have to ask this critical question: how does a Canadian small business actually protect its newly earned surplus from inflation? Because inflation is relentless. It steadily eats away at your purchasing power over time. If her money just sits there, stuffed under a digital mattress in a basic checking account, it's literally losing value. To create real wealth, she has to deploy her capital into investment products that generate returns higher than the rate of inflation. So, ironically, doing absolutely nothing is actually the biggest risk of all. Okay, let's dive into this. Here's our masterclass syllabus. We're going to build your knowledge step by step through foundations of strategy, cash and fixed income, equity investments, mutual funds, alternatives and derivatives, and then finally, tie the whole shebang together with portfolio diversification. Starting off with Chapter 1, Foundations of Strategy, Building the Base. Because obviously, no smart investment happens in a vacuum, right? Before we buy anything, we need to define exactly what an investment product is. Basically, it's any financial instrument or asset where you allocate funds with the expectation of earning a return over time. And these returns generally come in 3 flavors. First, you've got capital gains, which is just when the asset increases in value. Then you have income streams like interest, dividends, or rent, or you get a hybrid of both. Choosing the right products leads to long-term financial success, whereas poorly researched shoot-from-the-hip choices can lead to pretty devastating financial losses. So how does our tech consultant actually make those informed choices? She has to run her money through 3 foundational checks. First up, risk tolerance. What degree of wild variability in returns can her business actually withstand? Second, investment horizon. Is she investing for less than a year, or are we talking more than 5 years? The longer her horizon, the more risk she can comfortably take, simply because she has the time to recover from any sudden market fluctuations. And third, liquidity requirements. Basically, how quickly might she need to convert this investment back into cold, hard cash to cover a sudden business expense without taking a huge loss? That brings us to Chapter 2, Cash and Fixed Income, Safety First. Let's say our consultant realizes she might actually need her surplus in 3 months for a brand new software server. Well, in that case, she needs cash equivalents. We're talking savings accounts, money market funds, or short-term treasury bills. These offer absolute safety and immediate access. But, there's a massive limitation here: minimal returns. It's a wonderfully safe parking spot for emergency funds, but it absolutely won't beat inflation over the long haul. Now, if she wants slightly better returns, but still demands stability, she's going to look toward fixed income. When you buy a fixed income investment, you are essentially playing the bank. You're lending your money to an issuer, like a federal government or a big corporation. In exchange for your cash, they promise to pay you regular interest, which is known as a coupon, and then return your initial principal amount when the term reaches maturity. Government bonds offer super steady income backed by public funds, while corporate bonds offer slightly higher returns because, well, you're taking on the slightly higher risk of that specific company's financial health. Now, what's really interesting about this is a steady 4% figure. In Canada, guaranteed investment certificates, or GICs, are incredibly popular for conservative investors. Say our consultant buys a 5-year Canadian GIC, offering 4% annually. She basically locks in a perfectly predictable income stream with 0 risk to her principal investment. She knows exactly what she's getting and exactly when she's getting it. No surprises. Moving up the risk ladder to Chapter 3. Equity investments, pursuing growth. When you buy equity, you aren't lending money anymore, you are buying proportional ownership in a corporation. You actually become a shareholder. But it's important to know that not all shares are created equal. It fundamentally boils down to a comparison between common and preferred shares. Common shares give you voting rights and really high capital appreciation potential, but your dividends are definitely not guaranteed. On the flip side, preferred shares act a bit more like that fixed income we just talked about. They offer fixed dividend payments and give you priority over common shareholders if the company ever unfortunately goes into liquidation. So it's a classic trade-off. Do you want higher growth potential, or do you want reliable, prioritized payouts? And within equities, our business owner also has to choose a specific strategy. Does she want growth stocks? These are typically found in the tech sector, where companies reinvest every penny of their profits to fuel massive, rapid expansion. Or does she want dividend stocks? For example, she could buy shares in a massive, established Canadian bank. This is a brilliant practical strategy because she earns regular annual dividends, so a steady income stream, while also benefiting from the bank's long-term price appreciation over the decades. It generally means far lower volatility than a pure high-flying growth stock. Which leads us to Chapter 4, Mutual Funds, Pooled Professionalism. Let's be real, our Toronto tech consultant is incredibly busy actually running her own business. She might not have the time to sit there and research individual bank stocks or corporate bonds. Enter the mutual fund. These are incredibly efficient vehicles that pool money from multiple investors to buy a widely diversified portfolio, and the variety out there is just fantastic. She could choose equity funds for higher returns, bond funds for stability, balanced funds for a nice mix of both, money market funds for low-risk liquidity, or index funds. Index funds just passively track a major market index like the S&P 500, which means much, much lower management costs for her. The mutual fund edge is honestly undeniable. It drastically reduces your individual investment risk because our money is spread across dozens or hundreds of assets. It provides professional management, and it's highly accessible even if her initial capital is pretty limited. Now, of course, she does have to watch out for management fees and general market fluctuations, but mutual funds remain absolutely central to modern investing for anyone who wants an efficient, hands-off approach to building wealth. Now we're stepping onto the highest rungs of the risk ladder for Chapter 5, Alternatives and Derivatives, the complex tier. So the crucial point here is that alternative investments, things like real estate, commodities such as gold or oil, cryptocurrencies, and private equity, these fall completely outside the traditional world of stocks and bonds. Why on earth would our consultant look here? Well, because these assets often behave completely differently from the stock market. They have a lower correlation, meaning if the stock market takes a nosedive, real estate or gold might just hold their value, offering fantastic portfolio diversification and inflation protection. But be aware, they are often highly volatile, they lack strict regulation, and they suffer from limited liquidity. I mean, you can't exactly sell a commercial office building overnight. And then we have derivatives. These are financial instruments whose value is derived entirely from an underlying dependent asset. Think of options, futures, forwards, and swaps. They don't have intrinsic value on their own. While big institutional investors use them to hedge against risk or speculate on price movements, I really must warn you, these are highly leveraged, incredibly complex structures. They carry the risk of extreme financial losses and require a very high level of specialized expertise. This is absolutely not the place for beginners to park their hard-earned business surplus. Finally, Chapter 6, Portfolio Diversification, tying it all together. And this brilliantly illustrates the climax of her entire journey. Diversification is the deliberate, calculated strategy of spreading investments across different asset classes to minimize overall volatility and reduce risk. Rather than betting her entire surplus on one single tech stock, she creates a beautifully resilient mix. Consider this example allocation: 40% in equities for long-term growth, 30% in bonds for stable income, 20% in mutual funds for diversified professional management, and 10% in cash for immediate emergency liquidity. Because all these assets respond differently to economic conditions, poor performance in one area is very often offset by better performance in another. To really cement this diploma-level understanding, consider this your ultimate cheat sheet. When you map all this out, you can see precisely how equities offer high risk and high return for long-term growth, while cash provides low risk and high liquidity for those short-term needs. You can easily see how mutual funds balance the scales perfectly for busy business owners, while alternatives and derivatives sit way out on the far end of the risk spectrum for diversification and expert speculation. It's the entire landscape of investment products summarized in one clear concept. Which leaves us with one final, absolutely vital question to spark some action. Based on your personal financial objectives, your unique risk tolerance, and your time horizon, how will you construct your resilient portfolio today? The tools are now completely in your hands. Thank you so much for watching this explainer. If you found this breakdown valuable and it helped clarify things for you, please make sure to like this explainer and subscribe to the channel. We've got plenty more deep dives coming your way. See you next time.